What's going on, folks? Hamilton here with the Trading Initiative. Long time no see. Let's go through whether or not we think the bottom is in. That's the million-dollar question right now, particularly after yesterday's big ramp at the end of the day. Is this market ready to resume its uptrend? Are we approaching all-time highs, or are we going to come down and retest those early April lows? We are in the camp that the lows are in. And before you click off or tell me that I'm crazy, let me make my case. And then at the end, comment below and let me know what you think about it. The most important thing when it comes to trading after trend is support and resistance. These are the building blocks of everything that we do inside of the market as technical traders. So when we look back at previous cycle highs, in this instance, late 2021, early 2022, this resistance area that ended up being the peak of the previous cycle now comes down and acts as support. That piques my interest. That's something that I'm interested in, right? As technical traders know, resistance tends to turn into support during strong primary uptrends. So as the market was breaking down, and I'm not going to comment on the velocity of the market because I think it caught most people off guard, even people that were positioned short, covered their short way too early. I mean, this was an insane move to the downside. The fact that the 2021 highs near 475 held in the S&P 500 is information for me. That gave me an opportunity to anchor expectations, whether or not this market was going to continue to break down or not. We participated lightly to the short side as the market was coming down, but the million-dollar question for us was, how does 475 act? Do we break back down below? We were theorizing that if we broke below 475, this was going to be a deeper, steeper, and longer corrective phase in the market, really ushering in that bull market mentality. But if we held 475, we were going to look at taking pot shots and leading stocks. And so far over the last 12 trading sessions, that has been the play. We're making money to the long side in the market right now. And I want to point out before we go any further, that's not the consensus. The consensus right now is shorting stocks, right? That's what it is. If we look at the AAII Investor Sentiment Survey, retail is still max bearish. You can see this is the longest run of 50% or more bearish sentiment going back like 70 years. It's absolutely insane. Retail is incredibly bearish. And to give retail credit, they were bearish up here at the top as well. Everybody was making fun of them, including myself. Retail ended up being right on this one. They were the good guys, but they're still bearish here even after the market has bounced off 475 and really made a run at some very important levels up here near those July highs of 2024. So retail is still very, very bearish. And then actually, if we go and we look at professional money managers, they are also under positioned for this rally right now. You can see that they started to finally capitulate down into the 30s in the middle of April, and they're slowly adding exposure back to the long side here. But realistically, professional money managers are caught off guard. They have not positioned themselves adequately for this rally here. They've missed a majority of it, as a matter of fact. So you have retail with still overly bearish sentiment. You have professional money managers that are not properly allocated long right now, and yet you have a market that, quite frankly, for the last 7 straight trading sessions is vertical. I mean, I think the S&P 500 is on pace to hit its 8th straight green day. If you go back to 1950, this has only happened a couple of times throughout history. We do have a minor pullback generally coming up here, but this does start to push the narrative that the bottom is in. You tend to not see this type of move in a market that's going to double bottom or come back down and potentially break back below 475. Before we get into the supporting evidence here, I want to go through the NASDAQ and the Dow as well, because these are the 3 most important indexes in the entire market. The S&P, arguably the benchmark here, so we're going to start there. We have the RSI up and over the 50. We're still trading below a 200-day moving average, but if we go ahead and we throw an intermediate term moving average on the 50, we are now officially up and over it, folks. So not only are we starting to break back up on a short-term basis, we are now starting to break back up on an intermediate-term basis, and that has to happen before, obviously, we reclaim the long-term primary trend to the upside. That's why we're attacking how we're attacking in the market. If we go and we look at the NASDAQ here, the story remains the same. The 2021 highs held. Right? It's just that simple, folks. 405 held, which was the previous all-time high back at the end of 2021. We've bounced just like the S&P 500, and we're attacking those key levels from last July. We get back up and over the 200-day moving average. You have to be a buyer of stocks. You have to put all of the tariff crap, all of the Trump stuff, everything, the trade war, the actual wars that are going on, take it out of your process if you're a technical trader and own the stocks that are going up the most right now. Own the market leaders. Already up and over the 50-day moving average, so the NASDAQ is leading the market higher here, which makes sense because it's a higher beta area of the market. We're going to go through that in a second. The Dow Jones as well. Nobody wants to talk about the Dow, but arguably, at least in my mind, the most important index because it houses the most important stocks in the entire market here, also holding off that 2021 high near the 36,800 level. So all three indexes in confluence, they're all bouncing and holding those previous cycle highs, which gives us encouraging data here to start taking those longs. Now, remember, we need supporting evidence along with price action. We're not classical technical chartists, meaning that we don't trade just symmetrical triangles. Inside of TTI, we use a top-down process where we build the broader market picture and then go and actually pick the stocks that we think are going to best express that broader market picture and make us a bunch of money. So we know that price action is already hitting higher highs. There's an opportunity here for primary trends to be reestablished to the upside. But what we're really looking for is market breadth expansion. Right now, the Mag 7 stocks led the market to the downside. We're seeing them bounce, which is great, but what we want to see is market breadth expand at the same time. And two ETFs that we like to utilize is RSP, which is your equally weighted S&P 500. This is already back up and over its 2021 highs. For those of you that don't understand how bad of a drawdown what we just went through over the last 8 weeks, the RSP broke all the way back down in towards the 2023 highs. I mean, we gave back more than a year's worth of progress on an average stock basis. But now we bounced. We're up and over those 2021 highs. And just like the previous three charts that we looked at, those July highs are now within striking distance. We get up and over those. You got to be a buyer of stocks. Then if we really want to focus on the trader's dream, right, the higher beta tech stocks, QQEW is what we would look at, right? So instead of having the Mag 7 stocks be overly weighted inside of this ETF and really dominating the trend, we're seeing the average stock inside of the NASDAQ perform well, right? We're back up and over the 2021 highs and we're starting to trend higher as well. So yes, we do have that supporting evidence. Momentum is on the side of the bulls right now, which is another thing. Yesterday, bears had an opportunity to really beat down the uptrend here on a short-term basis. As a matter of fact, there was a good chance that they were going to. And yet at the end of the day, the simple concept of window dressing comes in. Larger financial institutions and money managers need to quote unquote window dress, meaning they need to sell their losers and buy the leading stocks on the last day of the month to essentially trick their investors so they don't get annoying client calls for the next week. Why don't you own Palantir, for example? And so you saw a lot of the market leaders really shine, and and some of those Mag 7 stocks that started to bounce as well. And that's what caused that thrust end of day in the indexes. But now we have this scenario where not only are financial institutions buying the Mag 7 stocks, they're buying frickin' everything, right? They flipped the green light at the end of April and said it's time to buy everything, which is why we got that big thrust at the end of the session yesterday. Something that I really look forward to when I see things improve is what types of areas are actually improving. If we go and we look at using Koifin sector strength here, get inside my mind for a second and ask yourself this question. In a strong, healthy market where people are net buyers of stocks, would you expect consumer staples and utilities and healthcare to lead the market? Probably not, right? You want to see things like tech, consumer discretionary, and communications lead the market. And as you can see year to date, tech and consumer discretionary have absolutely lagged the market. They got hit the most during this whole tariff fiasco. But realistically, they were weak coming into 2025, even before the tariffs were announced. So once again, as technical traders, we don't trade news, we trade price. And trends were already down in stuff like tech. For a matter of fact, tech topped in July of 2024. So they were already on the decline for a very long time prior to the tariff stuff. But what we want to see here is higher beta areas of the market start to outperform the lower volatility areas of the market. We want to see financial institutions, once again, I don't care what retail is necessarily doing. Retail doesn't have the buying power to move any of this stuff. I want to trade alongside the financial institutions. Where are they parking their money? This is what introduces these trends in sectors. When I see a market start to bounce, I want to see higher beta areas of the market bounce the fastest. Why? Because that means financial institutions are reparking capital in the more aggressive, offensively positioned stocks, right? The higher beta tech and semiconductor and internet and software stocks, the retail stocks out of consumer discretionary, and then to a lesser extent communications. If they were parking their capital in utilities and consumer staples and healthcare, that might lead me to believe that they're defensively positioning themselves for a bigger drawdown. But that's exact opposite of what we saw. If we go back quarter to date, which starts on April 1st, we see that tech is leading. And we saw that a couple of weeks ago, right? Tech all of a sudden, which was underperforming all year, and go back into the middle of 2024 underperforming, now it's starting to catch a bid. right? This stuff is sold off so much that now financial institutions are willing to buy this stuff. And so we took note of that and said, we need to get allocated into some tech stuff right now. And for the most part, we have avoided longing tech stuff this entire year. This was our real first green light to get long tech, and it's worked out pretty well so far for us. Number 2 here is consumer discretionary, your other higher beta area of the market, outperforming the S&P 500 and positive over the last, 5 weeks now. So tech, consumer discretionary, and communications just lagging right behind SPY. So we are seeing the higher beta areas of the market outperform, and that's great. That's exactly what we would expect in a market that has seen the bottom. If financial institutions are willing to go and buy those more offensively positioned area of the markets, we want to find the leaders and own them as early as possible. That's why over the last couple of weeks, we have said, let's buy some of those things. You can see some of the stuff that we have put out over the last couple of weeks here. This APH trade right now is up like 55, 60%, which is really awesome. We just opened it up a couple of days ago. You can see the type of stuff that we're opening up. Higher beta, super offensively minded stocks. We're not wasting any time here owning stuff in consumer staples and utilities. Spotify, which is up near all-time high. We opened up something like a Dollar Tree, bouncing off of some 52-week lows, but showcasing some bullish flow and an opportunity for a breakout here with a tight stop. You can see some of the stuff. Grindr is up at over 100% right now. Grindr, right? We were buying these things just a couple of weeks ago before everybody else wanted to buy them. It's super important, you guys, to be able to differentiate yourself between other differentiate yourself against other traders. If they're trading things like news headlines and tariffs and what the, what Bloomberg is screaming at you and CNBC and stuff, you're going to constantly be behind. That's why technical trading is so beautiful. The only thing that we're going to be paying attention to is what price is actually telling us, because all of the news that is coming out is inherently discounted into price. Okay. So right now we do think the bottom is in. We are buying net stocks. We are still cautiously optimistic until we get back up and over the 200-day moving average. That's kind of our line in the sand for full on bullishness or not, but we do have exposure to the long side. We are making some money here during this latest rally, and we don't think it's going to stop. Now, markets don't go straight up. Please keep that in mind. We will be hedging on the way up just in case we do get some pullbacks, which I do think we're in store for. If the market closes on a gap up into its 8th green day in a row, I do think we're going to have a pullback. It's going to cause late bulls to question everything. I hope it does, because then we get to scoop up more positions for cheaper and position ourselves for a potential run at all-time highs at some point this year. I have no idea whether or not we hit there. I'm just following price. And as of right now, short-term and potentially intermediate-term trends are flipping back to the upside. And I'm just a simple technical trader, so I'm going to trade along with the trend. Folks, if you like this type of content, please like and subscribe. Leave a comment below. Do you think the lows are in? Do you think I'm crazy? Is there anything I'm missing? And if you like this type of content, sign up for the free newsletter. It's in the description below. I send out one per day. I focus on one chart and tell you exactly why I'm focused on it and how, hopefully, you can use it to better your process to make more money. And eventually, when I send you enough emails and you like what I'm screaming at you, you'll join our premium service, which is also linked in the description below. You can use discount code if you've listened this far, MMB2025 for a 25% discount off your first quarter. I'm not going to put that in the description, but if you're still listening to me, there it is for you. Okay, folks, my name is Hamilton. I hope you like this type of content. Leave a like, subscribe, leave a comment. I'll catch you in the next video. See you guys.